My day job is about creating bespoke solutions for high net worth people who are normally asset rich or cash poor.
And what does asset rich cash poor mean to, just to give some context?
So basically, you may have a client that may have assets, let's say, I don't know, between 10 and 20 million.
Houses, properties, businesses,
Yeah.
gold,
Yeah.
shares,
Yeah.
lots of things.
Lots of different things, but they don't really have cash, or if they do have cash, it's not income generating cash. There may be capital gains where they may buy something, sell something,
Yes.
but they also need to borrow money.
Yes.
And they also may need to go out and get a mortgage. And that's where we would be creative in using their assets to find a solution.
And of course, it doesn't really matter whether that investment that they're looking at is a property and where they're looking over for capital growth over 20 years. There is also, if you're borrowing, then whether it's a capital and interest repayment or interest repayment, you still have to be able to service that commitment.
So if we have a client who's got no income but has assets and they want to buy another property or then a new main home, generally speaking, the regulatory authorities in the UK would have a high net worth exemption.
Mm-hmm.
That's normally a minimum of 3 million net asset or an income of 300,000. And then banks have an allowance where they can lend a percentage of the funds that they lend each year to look after high net worth clients with exemptions. So generally speaking, what I've learned over 20 years is banks can do whatever they want to do if they want the client.
If they want to do it.
Correct. If they want to do it, they can do it.
Oh, so it's company policy, it's banking policy, it's regulatory. Those are all sort of shields that they put in the way of needing to say yes to many other people.
I mean, generally speaking, if we can generalize, it's kind of like if you've got net assets of more than 3 million, an income of 300K plus, one would like to think from a regulatory perspective that those individuals have the financial ability and education to make informed decisions about the risks they're taking.
Yes. And is that being informed, that's the important piece.
Correct.
That they're willfully making those decisions based on a long-term appreciation of where their assets are, what they're trying to achieve, and affordability.
Yeah.
All of those things.
So for those people that are asset rich, cash poor, you can get what we call a forward funding facility. So what I mean by that is, let's say you've got stocks, shares, bonds, gold, crypto, you have other assets.
Sure.
So basically a private bank or a boutique lender will custody some of those assets on the other side of the balance sheet in order to lend you money to buy the property. So let's say your asset position is 10, you're buying a house at 3 million, you have no real income. So what we would do is we look at the assets, so study the individual assets that you've got, see where the lending values are and what the asset value is in terms of liquidity.
Sure.
So from a bank's perspective, they're going to lend you money, you've got no real income, how are they going to get repaid? What are the risks? So for them, it's kind of like, and our job as a professional advisor is to study those investments. So if it's stocks, shares, bonds, crypto, gold, look at them to say, okay, what has a lending value? What is the most liquid asset that you can then custody on one side of a bank's balance sheet in order for them to lend you money to get a mortgage? And we would look at them what we call a blended facility, where you're going to custody some stocks and shares. You're going to give the bank security over the property. The bank takes security over those two assets to then lend you 100% for the purchase, and also would release some equity, cash, to service the interest, normally for the next 5 years.
And actually, that sounds far more pragmatic as well, that blended finance approach, because, personal guarantees, bonds against properties, but then as you've just described, those interpretations, it's something that banks seem not to be too approachable about more generally, but obviously for high nets, I guess it's a slightly, in the same way that LTV, loan to value, clearly doesn't mean the same in these arrangements we're talking about for these kind of investments, does it? As it would do to a...
Yeah. I mean, so basically each asset class will have an underlying loan to value. So depending on the property value, that will determine the lending value of the bank. So they may say, okay, the property's worth 3 million. We're comfortable on the property to go up to 75% loan to value. let's say the client may have crypto, and there are lenders that lend up to 60% that are regulated in Switzerland, Singapore to lend against crypto. And you could probably do a 60% loan on the crypto, 75% on the property, put them together.
Yep.
You have 100% security from the bank, and you have probably 20% additional headroom for debt servicing.
Yes, and fluctuations in values and markets and whatever else. It just seems a very pragmatic and sensible approach.
So in terms of the world, there are thousands of banks all around the world that have the ability to lend. It's just a question of the appetite. So sometimes at the start of a year, banks will be keen to get their objectives being achieved, or may lend more aggressively. And the back end of a year, sometimes lenders will lend aggressively again to achieve those objectives. It just depends.
And just looking at that we talked about base rates earlier on. I mean, the quantum of uplift from 0.25% to 5.25%, significant. However, most of us that have actually borrowed and had mortgages over the long term recognize base rates at 5%, were the norm. It's not the norm now. And who knows where it will settle back. But when you look at that base rate rising, has that had a significant impact on how banks then look their appetite for, let's say, just commercial property lending?
No, 100%. So all banks will have a base rate, then they'll have a margin which they'll lend. That is determined by swap rates in the marketplace. So swap rate is where people will buy and trade money, and then banks may borrow in money to lend out. So they'll have base rate, cost of funds, plus a margin. And then they have what we call stress testing. So let's say base rate's 5.25% today, margin's 1, debt is 6.25%, but they will stress test that debt at probably 8, 10, and 12% to make sure you have the headroom for any uncertainties. And no one would have thought that base rate a year or so ago would have probably 14 consecutive rises to go from 0.25 to 5.25%, probably one more to go to get to where we are today.
Yes. And it's ironic, isn't it, that 14 consecutive increases were meant to actually try and constrain and reduce inflation. In actual fact, you can see no real correlation between the two things. Well, I come back to the Bank of England. I'm not blaming the Bank of England, but their purpose. I think so.
We should have done something sooner, quicker, and
less, ending up less painful for a great many people that probably were the people that could least afford it. Which is frustrating. That's why I think we have to have. We've talked about innovation. You've talked about entrepreneurial approach and the dynamics, and I think just we need to be clever and smarter, and not just the same old profiles that we've applied to lending decisions in the past.
But I think for me, if you're borrowing below $1 million, it's all about credit score.
Yes.
So it's about your income, affordability, and it's your bank statements. And most banks, in terms of digital mortgages, will plug in your bank account to their credit score and affordability to give you what you can borrow.
Yes.
And that's, unfortunately, computer says no or yes for most of the high street banks. There are specialist lenders that will look after self-employed people where you can have a conversation, you can deal direct with an underwriter. So if you're a self-employed person looking for a mortgage, deal with a professional advisor who will have access to lots of different banks that can be bespoke for you to look at what can you do and understand it. And many building societies in the UK specialize in helping people whose circumstances are a little bit more complex.
We were talking, I think it's absolutely right. We were talking just before we came on camera a little bit about debt, and is debt a good thing? Is it a bad thing? And it's certainly not the same thing for everybody. And that I'm not just talking about people with different either assets or financial situations, but it's also about people's mindsets and how people feel. You can have somebody who has significant leverage, but actually they're very relaxed because actually they see it as just being a vehicle. Other people that would say, we've got significant debt, significant leverage, and we're uncomfortable with that. We just don't like that. So from your point of view, just talk to me a little bit about people's appetite around debt and leverage. And I realize leverage can be different to debt per se, but do you have any observations just around the merits or the risks and pitfalls around?
So if you're buying a property in the UK, it's really important to look at inheritance tax planning. So obviously if you pass away, you're taxed very heavily in the future when you're no longer here. But the only time a mortgage and debt counts for inheritance tax purposes is at the date of purchase. So it's really important to get tax advice. And in those sort of circumstances, having a mortgage and having debt is a good thing. And I personally believe that generational debt, so you may have a mortgage and an asset, and then you pass that mortgage and asset to your children for the future. So the debt is X and it stays with them forever. Now, there are a lot of people, more mature people in the different generation, who think debt and the mortgages are a bad thing and they shouldn't have them.
We must clear a mortgage before we give that inheritance. And that could have some pretty dire tax implications.
And the other thing is
unnecessarily so.
Yeah,
unnecessarily.
A lot of the time we see people that don't have a will, just basic planning. Even David Gold, the former West Ham owner, didn't have a will. And it's just shocking that people, even at that level, assume that their arrangements are in order. And a lot of the time, people's arrangements are not in order, and it's so important to get them in order.
It's actually reckless, because potentially your family and perhaps business partners, because of course, if you own a company and they own the shareholding, it can be a very, very messy and a very extended messy period trying to sort out those things. Simply, where's all the paperwork? Where are all the certificates? Actually, what's the term on those? It can be very relative at a time when people are obviously grieving for a loved one and it may well have been somebody who was looking after the finances for the family. And
life cover, whether it's personal or business protection, if you're directors and senior people in businesses, super important. And also it's tax deductible if it's put through the business, it's for the business. So it's important to plan.
So from your point of view, looking back to all of your experiences with your clients and business, debt absolutely is not a bad thing, but it's about making sure that it's the right sort of debt for the right reasons, both kind of short, mid, and long term. Because there may be a different decision if you're looking at something that you want to see through short, mid, into the long term. But if it's very much a short term objective that you have, then you might have you should have a different view, appetite about the extent of it and the cost of it, I guess.
Culturally, we find more of our clients from China, Hong Kong, Singapore are more aggressive with leverage. So they may leverage their assets harder and stronger and have clear planning and reasons why. So for example, go back 3 years, you may have been able to get 50, 60, 70, 80% leverage on a property and pay rates in around 1.5.
Yes.
If you're then investing that money and you're getting a return of 10 plus, then it makes sense to use leverage and borrowing to acquire other assets and trade.
And that could be I guess the reason, why would that be the case? It could be cultural. It could be at what stage in the evolution of that country's, sophistication development, if you like. I guess, couldn't it? I mean,
I do think generally speaking, clients from those countries probably more aggressive than others on leverage, unless you're in financial services of private equity, VCs, hedge funds who are using leverage all the time to achieve IRRs, etc. Then it's different.
IRRs for people that not everybody. I did say we mustn't get lost in the
rate of return. Mystery. So if they've got a target return of 20% per annum or 25% per annum, if it's cash, and then sometimes with a little bit of leverage, you can get a better return on your capital that's deployed.
Yeah, and that's why it's sophisticated, but it doesn't have to. It's not as complicated. It's sophisticated, but doesn't have to be complicated.
Agreed.
So, Paul, with base rate being so high, as we said before, and it's fair to say, fair bit of uncertainty in the financial markets, driven by uncertainty around economies in reality. Certainly short term. What's the cheapest way to borrow? What and also the smartest way to?
No, it's a very good question. I mean, base rate at the moment in the UK is 5.25%. So most people aren't aware of single stock lending. So a single stock would be whether you've got Vodafone shares, Google, etc., etc. And globally, right now, anywhere in the world, single stock lending is the cheapest. And so, for example, pay rate is 3.25%. So you could custody your stock on one side of the balance sheet. A specialist company will lend up to 63 to 65% of the value.
Sure.
And that money is fixed for a minimum 18 months to 2 years at 3.25% with arrangement fees. Now, it's not for everyone.
No.
But you can get cash and liquidity within a couple of weeks if you need it.
And that 18 months, we used to talk about short-term, long-term. I think all of those timeframes, actually anything beyond 18 months ahead is probably unwise because there's just
goes so quick.
So much happening and so much happening around it.
And that is called, that arrangement is the sale and purchase agreement. So basically, I've got shares, I sell them to you, and then later on, you basically return them to me. So you give me cash,
Sure.
I give you shares. And the great thing with that particular lending, it's non-recourse lending. And what I mean by that is that if there's a margin call, so let's say I borrow 6 million on 10 million, when the share price, and if it was to drop from 10 million to 4.8 million, you get a margin call.
Yes.
And I can either top up with shares or cash to keep the position, or like some clients do, is I can keep the cash, you keep the shares, and the agreement ends.
Falls away. Yeah.
And it ends.
And everybody accepts the hit, if you like, at whatever level.
But the company that's lending the money is very happy to hold shares for like 10 or 20 years.
Oh yes, because their time frame can be very different.
Correct.
Absolutely.
So right now, that is the cheapest way to borrow. So if you're analyzing a client's circumstances, who is asset rich, cash poor, and going around looking at what we call a blended facility. So you've got a single stock, you want to buy a house, what's the cheapest, most cost-effective way to borrow? And that can be dollars, yen, euros, Swiss francs. That is the cheapest way to borrow right now.
And just expanding on the point, because I think a lot of people have different views about shares. The danger about having a share portfolio or an investment in a share and looking at the price every day is, it's worth that much now. And you know what I'm saying it's never worth anything until you actually sell it. And so the number of people I've found that get very confused about how they value, that, and they forget about what they originally invested. And of course, the very wise investor is invest, then draw that back.
Everything is easier in hindsight. And for me, when I look at my career, I had 3 or 4 opportunities from very big companies to sell my business, and I should have sold. So the advice I give to people now, if you're running a business, sell it, bank the cash, and then go again, having that financial security and stability for the future.
Sure. Well, that's smart, isn't it?
Now I know it,
that's smart.
And it won't happen again.
Yes.
And a lot of things I've learned will never happen again.
It is. What you mustn't do, I think, with share ownership is don't treat it like it's a casino where you actually, I'm gonna win lots. It should be about invest in it because you believe in it and you believe it's got, and then see where that takes you. But at that point where you've seen sufficient increase in that share value, that share price, then actually cash in your original stake.
100%.
And then go find your next investment, and then you allow that to grow. And you can be very smart around, I think, investing in your share portfolios.
And the next way when analyzing assets is portfolio lending. People call Lombard lending and margin lending. Lombard lending, not to be confused with the company, and margin lending. Lombard lending and margin lending are the same.
Sure.
So you can custody your shares and your portfolios, again on a bank's balance sheet, and they will lend you a margin over the cost of funds. So you could pay between 50 and to 100 basis points for a margin loan, Lombard loan. And the difference for the stock loan is that stock lending is at, say, from 3.25%. Margin lending is probably 5.75 to 6.25 on a sterling basis at the moment. So, that's also a cheap way to borrow.
Sure.
Because we have volatility and uncertainty in the markets today, tracker rates for mortgages from probably 1 to 15 million, sub 60% loan to value, there are lenders lending at 0.14 over base.
Sure.
So if you've borrowed more than $1 million in the last 5 years, you are well worth looking at what am I paying? What could I be paying? Because you probably, average margins have been probably 1.65 over base. You can probably get it for 0.14 sub 60. 75% loan to value is probably 0.33%. So right now, tracker money is super cheap, and it's probably cheaper than Lombard lending. And it's well worth having a conversation to see, for those million plus people that are borrowing money, what were you paying and what am I paying now?
And I think the pull out from that is when the markets, when economies, when the financial markets are in different phases and stages, then sometimes the type of borrowing that you might look at, your appetite can change to reflect that. In a changeable environment, then you should be flexible. I'm conscious that, of a couple of things, but one of them is that we're coming towards the end of our time. So I've got two questions. One is, how frustrating has it been not to have control of the mic during our conversation? Because as you say, you're normally broadcasting and you're normally, so how uncomfortable, frustrating has that been? And then the second, bearing in mind all of the volatility and the uncertainty and the problems that are happening out there in the world that we're all aware of, and then coming back to this year of big change and transition and volatility and change that you've experienced, with your insights around all of that, just what are your big thoughts about as we move into Q4 of 2023 and 2024? So we said we won't look more than 18 months. So let's just as you see things, just at the broadest top level. It'd be interesting, I think, to people listening, just where you are. So first one is, how frustrating has it been for the last half hour not to be in complete control? Although another Paul being in control, and then just your big reflective thoughts about where we are and where you are.
Mostly relaxed about not being in control. You've done an amazing job. And if you'd like to see Paul again on the channel doing the interviewing, then please comment below and we can get him back and he can interview some other people.
I don't think I'm not looking forward to seeing the result of that poll.
In terms of my honest opinion of life right now is we're not adopting technology fast enough. Wherever I've been in the world, whether it's Miami, Dubai, London, Guernsey, wherever, there doesn't seem to be enough people to do the work. Secondly, benefits, in my opinion, are too high. There are too many people that could be working and they get more on benefits than actual employment, which is kind of sad to say, but I think that's wrong. Although in the future, that may become the norm. And what I mean by that is that with AI, we're not adapting, becoming more efficient with AI. And we need to, basically, I was very lucky to be at a presentation by the former CEO of Amazon UK for Europe and the UK. And every single small business in the world right now has access to all of the tools that the big companies have been using for the last 10 to 20 years. So we need to get on board with the AI business. It's the next industrial revolution, and we need to be investing in it now, adopting it, using it, and pressing on.
So looking after your health, looking after your wellness, having the right priorities, but making sure that you capture the things that can actually make the life business work better, but on your terms.
No, agreed.
And that's probably a good message for us all.
Yeah. So Paul, thank you very much indeed. And
enjoy your weekend. It's been good talking to you.
Thank you.
Thanks.